Welcome to the Note Nuggets podcast, where you can learn how to become the bank, build wealth, and accumulate streams of income perfect for your savings or IRAs. You'll hear from industry experts, seasoned veterans, and everyday investors. Our goal is to teach you how to invest in notes, one nugget of knowledge at a time. Here's your host, Kevin Galang.
Welcome, everyone, to another episode of the Note Nuggets podcast, where you learn how to turn other people's debt into income for your savings or IRA. Whenever someone asks me why they should invest in notes, the simplest answer I can provide is cash flow and passive income. Because when a note is performing, you get that mailbox money a landlord does without the headaches of dealing with maintenance and tenants. It doesn't get any more passive than that. Each month, your borrower pays you the principal and interest money, and you go along your merry way to do whatever it is you want to do. Couple this cash flow with the fact that your investment is secured by a real property that you could reclaim if the borrower doesn't pay you, and you have a recipe for a phenomenal investment that provides returns that are not tied to the success or failure of Wall Street. In a future episode, we'll look at whether or not notes are immune to things like the stock market and the housing market. But knowing that your cash flow is consistent makes your life more secure and less stressful. And by my definition, that is a win-win of an investment. I'll always make the argument that notes can be a great investment for every investor. Well, there are many reasons for this. The reason we're focusing on today in this episode is diversification. Diversification is what many investors say is the best way to hedge your bet, but also protect your money. With all your eggs in one basket, like stocks or even real estate, if that basket breaks, gets dropped, or starts to wear out, then your eggs can start falling. However, if your eggs are spread across multiple baskets, then if one basket breaks, the other baskets are there to keep you afloat. Of course, the question then becomes, how should you diversify your investment? And unfortunately, you're not going to like my answer. Because with many things in life, the answer is, it depends. It depends on things like your risk tolerance, how much money you have, your time horizon, and investment goals. It's really impossible to answer such a complex question with a simple answer. I know you're hoping for one, but there isn't a simple answer. And if anybody tells you that there is a simple answer, I would question what it is they're going to sell you or provide you. Now, knowing that diversification is a key factor to investment protection and success, our guest is going to break down why diversification is a reason people decide to add other people's debt into their portfolio. Before we learn about our guest, don't forget to leave the Note Nuggets podcast a review on Apple Podcasts so that we can connect with like-minded, savvy investors like yourself. For instructions on how to leave an Apple Podcast review, head over to notenuggets.com/review. Lastly, if you have any questions about how to invest in notes or want to learn more about how I'm creating cash flow and building wealth for myself and my investors, book a time on my calendar at notenuggets.com/contact. Now let's learn about Fred. Fred Moskowitz is an author and investment fund manager who is on a personal mission to teach people about the power of investing in alternative asset classes such as real estate and mortgage notes, showing them the way to diversify their capital into investments that are uncorrelated from Wall Street and the stock markets. In his newest book, titled The Little Green Book of Note Investing, Fred publishes his concise yet definitive guide for new investors seeking to learn about the market niche of investing in residential mortgage notes. He's a frequent event speaker and contributor to investment podcasts and note industry conferences. You can visit him at fredmoskowitz.com or by texting the word NOTE, N-O-T-E, to 47177 and following the prompts. Fantastic. Well, we're going to go ahead and dive right in. We're going to talk about cash flow with notes and what are the most common ways investors in the note space can create cash flow. Is it even attainable for note investors?
Absolutely, it's attainable. And I would even add that this is one of the primary benefits of note investing and why most investors get into it in the first place. It's because they're seeking an investment that gives cash flow and income. And frankly, I feel that everyone should consider owning debt as part of their overall investment portfolio, whether it's in their retirement account, like in a self-directed Roth IRA. Notes are a depreciating asset, and we can get more into that. It's not like real estate, which is generally an appreciating asset. But notes have some unique characteristics about them. And the main one is that they throw off cash flow. And depending on the type of note you invest in, it will be immediate upon closing, which is nice.
So when you say everyone should have it in their portfolio, what's
Yes.
the, the immediate question I have is why,
For
right? So I'm curious.
diversity. Yeah, diversity, right? Diversity. So important. And I speak with investors all the time, Kevin, all the time. And people that are not in my world, in our world of alternative assets, alternative investments, right? Think about this. Maybe colleagues that you encounter in your work, right? People think that, oh, I have my 401k at work. I contribute to that. I'm investing there and I'm diversified because I split my investment among the half dozen or so investment options in my 401k plan, right? Well, that's a huge fallacy. It really is, because all those investments are stock market products, Wall Street products, and everything's tied to the markets. Everything's tied to the stock market. So with notes, right, specifically with notes, these are uncorrelated from the stock market. They're going to be generating income on an ongoing basis. It doesn't matter if the stock market dropped 50% in the next week because there was a huge downturn. You're still going to be getting income on your notes, right? For the most part, people aren't going to stop paying on their note because the stock market just crashed. It doesn't happen. And what I found, I mean, I don't know everything, but one thing I found in my experience is that people prefer to live indoors, right? So they're always going to be making their housing payment a priority, whether that's rent, whether that's a mortgage payment. And so you have that income. It's not guaranteed, of course. However, the likelihood is very high. You're going to have that payment income coming in. And if you diversify in a nice note portfolio with many notes, now you have your risk spread out pretty nice. And so, yeah, there may be a missed payment or two here and there, but overall the portfolio carries itself well. And that's what I mean about the diversification. Now, we could look at this from the economist perspective, where people can make the argument that notes are a great hedge against inflation. And here's the reason why. If there's a change in inflation in the future, and you have these massive corrections, right? Well, if you bought a note at a discount, you're building in some downside protection there because of that discount. And so that helps to insulate you from any risk of inflation. The inflation will still impact you, of course, but there's a hedge against it. And so by all means, I'm not saying that anyone should put all their capital into notes. Absolutely not. But for a well-diversified portfolio, it's a great way to have some portion of your holdings in a asset class which is going to carry its own. And if there is a downturn, it's going to be generating income along the way while you're waiting for things to stabilize in other asset classes.
That diversification piece is a different perspective that I hadn't thought of, and it gets the gears going on my end, where I think about because we're going to talk about depreciation next. What I love about notes is, regardless of how the market performs where that borrower is living, it could jump 100% and their house could appreciate 20-fold or whatever the case may be, you're still going to get that payment.
Right.
And it could-
Or if the house value goes down, people will
Exactly.
still pay.
Yeah, they're
People-
legally obliged to pay you. And that is an advantage. And I
They
love
are.
that.
I mean, I've owned properties for many, many years. Value has gone up, value has gone down. However, rental properties, it's an ongoing business that I intend to keep going. Therefore, I'm making those payments. It doesn't matter to me if the value went up or down 10%. I'm still making those payments. The loan's still getting amortized. All those things are still happening. And the reality is people have a pride of ownership in their homes, in their properties, and they're going to continue to make those payments as they agreed to when they took out the loan in the beginning.
Yep. I 100% agree with you. So if somebody comes back and says, your note's a depreciating asset, which in theory, in practice, rather, it 100% is, right? The highest price you can get on your note is whatever you'd sell it at today. That being said, what's the counter argument for saying, hey, your note's appreciating while my rental is appreciating?
It is. It's not an argument. I don't look at it as an argument. It's an alternative point of view, and it's a different asset class. I hate people that get defensive about arguing whether real estate or notes are better. One is better than the other. They're both great. They both have their advantages and disadvantages. I love both. And I think for most people, you should seek to own both, right? Some of the disadvantages of notes are that it's a depreciating asset. And the reason it's depreciating is because the loan balance is decreasing over time. Every month you have a mortgage payment, you have principal, pay down, and interest. So as that principal gets paid down, the loan balance decreases. You're receiving that back. And so for you as an investor, you're going to have this pool of cash building up throughout the course of the year. Those monthly payments, it's going to accumulate. And so your job as an investor is to redeploy that cash whenever the opportunity presents itself. So you stockpile it up a little bit, and then you have an opportunity to buy maybe a new note or invest in a real estate deal, and then you redeploy that cash. If you sit idle and let it sit there, the return on that is going to be zero, and it's going to drag down the return on your portfolio. So you always have that work as an investor. Your job is to be efficient about redeploying that cash. So if you have a note that pays off, you get a payoff sooner than you expected. You have to redeploy that cash. Don't go out and spend it foolishly. Reinvest it, buy a new note, buy a partial, do something else to put the capital back in play and be earning a higher rate of return on it.
Diversification seems like a catch-all investment term, but it's a tried and true way of not only protecting your downside, but being able to make profits in other investing asset classes. If you want to learn more from Fred, sign up for his full interview at notenuggets.com/diversification. And if you want to diversify your portfolio with notes today, book a time on my calendar at notenuggets.com/contact.
Thank you for tuning in to this week's episode of the Note Nuggets podcast. Be sure to subscribe to the show to get access to additional weekly value nuggets and get notified with episode updates. To subscribe, all you have to do is head over to subscribe.notenuggets.com. If you have any questions about this episode or note investing, book a time on Kevin's calendar at contact.notenuggets.com. We'll see you next week with another note nugget to add to your tool belt.